deductions. So the whole point of this is when is an expense of a business deductible? And it's really not that confusing, right? I mean, the answer you can give and be right almost all the time is when it is incurred to gain or produce income. Okay, and the important thing here is that this is in expectation, right? So you can incur an expense and hope that it will generate revenue, and that may not happen. But if your intention or your expectation was that you spent that money with the sole purpose of gaining, that's a G, of gaining, to gain or produce income, then it's going to be deductible, right? We have these exceptions that we talked about actually in the last video: not capital, not personal, and it has to be reasonable. But really, when it comes down to it, this is all we need to know about whether things are deductible or not. Was it spent for that purpose? Then the things we end up with in section 18, all these things that are listed under the heading of things that are disallowed or limited, is basically saying, okay, yes, it's true. If you incur it to gain or produce income, then it should be deductible. However, here are a bunch of places where we are going to make a pronouncement that sounds like it was made in medieval times. No deduction shall be made. Okay, and so let's just look, and I won't write a whole lot here. I'll just talk. So, and these are all referenced. So 4226 talks about reserves, and for our purposes, that's contingent liabilities. The Tax Act is not like the accounting treatment of contingent liabilities, which is, nothing has been paid. We're just going to accrue something in case it's paid. Well, tax says no, thank you. Club dues. So we've met this one already, and it's just a specific, more of a social policy. One would think you shall not deduct club dues that you pay on behalf of your employees. For cars, all we do, and I know cars, here's another thing about cars. You go, how many things can we do about cars? This is just, when the employer is paying, so the employee owns the car. I'm just writing down these limits. When the employee owns the car, so that's important to note. If you're going to reimburse them, so this is basically the other side of that allowance that we learned about on the employee side. When you're going to give them this allowance, the max you can give them is, when it's based on kilometers, 52 cents. If you give them more than that, we're not going to allow you to deduct more than that. And so that's for the first 5,000 and then 46 after that. But basically all we need to know here is that they cap it. So you can't say, okay, we'll reimburse our employees $100 per kilometer and basically get a deduction for us and a small income inclusion for them. You can't do it. Okay, penalties and interest. So this is really anything that you have to pay to the CRA. We are just going to say, no, you're not going to get any tax relief for that. Okay, just a specific exclusion. We talked about actually in the online thing yesterday, this home office can't create a loss. So you can deduct, can't create or make worse a loss. Okay, so there's just one limit we put on it. And then the last one, so I haven't been good about keeping up these numbers, so you can fill them in and go to your textbook, but accrued expenses in 4236, really, if you have a genuine liability, you can accrue under tax. So if you owe somebody money, but there hasn't actually been cash change hands, you can have a deduction for that if it's genuine. The issue really arises when there are related parties, because we can start moving income between taxpayers and getting preferential rates or deferral because we're working together, right? We have each other's interests at heart because we're related. And so these two things are basically unpaid amounts. And so in general, all we say is you can it can remain unpaid for 2 years. After that, it comes back into income. And then for salaries or bonuses to a related somebody who's related to the corporation, it has to be paid within 180 days. Okay, so if you don't do if you do those things, then absolutely you can accrue before you pay. But if you don't pay within these time frames, then we're going to include it. Okay, now section 4239 of the textbook. So these are, hopefully everybody's clear, these are textbook references, not Income Tax Act references. We have met these things that get limited, so meals and entertainment. And I think everybody just sort of knows this one. 50% is included. Interest on car loans. Okay, so very specifically, if you borrow money to buy a car, you can deduct a maximum of $300 a month. So this is just consistent with that $30,000 cap that we see on the CCA side. It's basically saying if you go out and buy a very, very expensive car, we're only going to give you tax relief for at a cap of $300 a month. And so actually in the law, that number is $250. Administratively, it's been changed to $300, and so these numbers rise as needed. Well, actually they don't really rise as needed, but they rise when somebody finally gets around to saying, hey, that number should be higher. So right now the lease amount is $800 a month. Okay, so those are just set by statute, and that we're going to cap you, and it's consistent with the as we've seen on the cost side. Okay, so the last thing that we have to so all we've really done here, just to recap, all we've really done is say you can deduct whatever you want with some exceptions, and I have definitely not listed all of the exceptions, but as we have done the problems already, and what the ones we'll continue to do in class, those are the ones that we will hone in on, and those will be our examples. There's always going to be a nitpicky one somewhere, but we're not going to concern ourselves with those. We want to get the general principle of, okay, does it make sense? And each of these sort of has their own policy reason for being not allowed. But then what we need to talk about is this last thing in 4240, which talks about what's permitted. And really what we're doing is we are deducting what has been previously, for lack of a better word, disallowed. So if we've added it back, or we've said, you know what, under the current law, if we don't have these specific permissions, we've got these things that say you cannot deduct something, but we need to add something. It's basically the financial accounting way of doing it. You can't do it that way. So we need to put back in the tax. So really, this is things like CCA, and cumulative eligible capital, which we will talk about. So this is actually next class that we go in this. So this is chapter 5. We'll go into some detail on this, but this type of thing, and then things like interest and financing costs and